Covenant Logistics Group, Q2 2026. Bottom line, they missed consensus.
Yeah, and the stock reaction definitely reflected that margin erosion right out of the gate.
Right. I mean, diluted EPS sat at just 32 cents, or 42 cents on a non-GAAP adjusted basis.
Which is a pretty noticeable drop from last year's adjusted 45 cents, so yeah, definitely a miss there.
Exactly. But here's the wild part. Total revenue actually came in at $332.9 million.
That's a nearly 10% jump year over year from $302.9 million.
Yeah, a $30 million jump. You have a transportation company growing top-line revenue by that much in a supposedly strengthening freight cycle, yet profitability is actively shrinking.
Well, when you see top-line growth completely failing to translate into net income, it signals, serious operational friction.
For sure.
Even Chairman and CEO David R. Parker noted in the release that while they made constructive changes on the revenue side, their costs quite simply disappointed them.
Disappointed is a good word for it. So today's deep dive is pulling apart Covenant's Q2 2026 earnings report and the financial tables. Our mission here is to reverse engineer these quarterly financials to understand the underlying mechanics of the current freight market.
Because it's really not just a standard inflation story.
No, not at all. We're looking at how shifting business models and logistics mean higher revenues can actually destroy margins if a company isn't meticulously managing its transition. And we're going to figure out exactly where that $30 million in new revenue just evaporated.
And to find where the capital is leaking, you really have to look past the consolidated income statement. You have to analyze the unit economics of their combined truckload segment.
Right, the actual physical trucks.
Exactly. Covenant is aggressively restructuring its operational footprint right now. They are deliberately moving away from commoditized, uncommitted spot freight.
The stuff anyone can haul.
Right. During this quarter, they actually shifted 15% of their expedited fleet away from the spot market and locked those assets into multi-year committed contracts.
Okay, and at the same time, they're heavily concentrating their dedicated segment into the agricultural protein supply chain. So, hauling meat and poultry.
Yeah, huge shift there.
But, looking at the actual physical fleet metrics, it looks like a company in retreat. Their average fleet size dropped 3.3% sequentially. And the average miles driven per unit is down 8.0%.
Yeah.
So wait, let me push back here. Why shrink your physical footprint and idle your assets when the broader freight cycle is reportedly entering an upswing? Aren't they just leaving market share on the table for competitors who are willing to run the spot market?
Well, they are, but they're willingly ceding that low-margin market share to capture high-margin duration.
Okay.
Just look at the yield metric. Despite driving 8% fewer miles with a smaller fleet, their freight revenue per total mile jumped 15.1%.
15.1%. That is a massive pricing increase.
It really is. The spot market for dry van freight is essentially a race to the bottom, right? It's highly transactional, highly volatile. By shifting into agricultural protein, they're entering a very specialized logistics market.
Let's break down the mechanics of that agricultural protein market because, hauling chicken isn't the same as hauling pallets of consumer electronics.
Oh, not even close.
You are dealing with strict temperature controls, specialized refrigerated trailers, and intense USDA compliance. If a reefer unit fails in transit, an entire load of poultry spoils, and that carries massive liability.
Precisely. The barriers to entry are just significantly higher. Shippers in the protein supply chain, they cannot risk relying on random carriers from a digital load board.
Right, you can't just hire a random guy with a truck for raw chicken.
Exactly. They require guaranteed capacity, perfect on-time execution, and rigorous trailer washout and sanitation procedures. Because the stakes are so much higher, these shippers are willing to pay a real premium.
And sign long-term, multi-year contracts to secure that reliable capacity.
You got it.
So I see the strategic value in trading volume for yield, right? Securing long-term contracts builds a moat around your revenue. But relying on multi-year committed contracts can also be a massive trap if inflation outpaces your contracted rate escalators.
Oh, absolutely.
If diesel prices, driver wages, or insurance premiums spike, you are locked into a rate that might have looked great in 2025, but operates at a huge loss in 2027.
That is the perpetual risk of the contract market. However, contracts in specialized freight environments like temperature-controlled logistics, they typically feature more robust pass-through mechanisms.
Like fuel surcharges.
Yeah, fuel surcharges, accessorial fees, things that protect against that inflation better than your standard dry van contracts. The CEO explicitly stated their goal is to have substantially all of their asset-based business under long-term dedicated or committed contracts by the end of this current freight upcycle.
Okay, so they want to secure their pricing peak and just ride it through the inevitable next downturn,
Exactly. They're playing the long game.
which makes sense. And over half of that 15.1% increase in revenue per mile was driven purely by this mix shift into specialized freight.
Right.
Yet, we still have to reconcile the headline paradox here. Yield is up substantially, but combined truckload margins failed to expand. The earnings report points directly to a surge in equipment maintenance, insurance, and claims.
Yeah, those are the cost gremlins.
Management actually disclosed that maintenance and insurance alone hit earnings by approximately 8 cents per diluted share compared to historical averages.
That's a huge hit for a single quarter.
It is. Let's start with the maintenance side because their capital allocation strategy looks, frankly, incredibly risky right now.
Well, they are exhibiting extreme capital discipline. Net capital expenditures for the first half of the year were less than $1 million.
Wow.
Yeah. They are largely funding their limited equipment purchases by selling off older assets and downsizing the total fleet count.
But the result of that discipline is an aging fleet. I mean, the average age of their tractors increased from 22 months last year to 26 months this quarter.
Yeah.
And they project it to hover between 25 and 28 months moving forward. This looks like a dangerous game of deferred maintenance.
It definitely alters the risk profile.
Right. They are trading fixed capital costs, the depreciation of buying new trucks for variable operating expenses.
Because when a Class 8 truck crosses that 2-year mark, the calculus changes completely. The comprehensive warranty coverage often begins to expire. You start seeing compounding wear on diesel particulate filters, selective catalytic reduction systems, the transmissions.
Exactly. You avoid taking on debt to finance new trucks, sure, but you get crushed by emergency roadside repairs, inflated parts costs, and just the massive opportunity cost of a truck sitting idle in a repair bay instead of, generating revenue.
Right.
So is the balance sheet discipline really worth an 8-cent direct hit to earnings in a single quarter?
Well, Covenant is betting that over a full economic cycle, the capital savings and the debt avoidance will outweigh these variable maintenance spikes.
Okay, over the long term.
Right. But you are correct that in this specific quarter, the variable costs surge way beyond their projections. The part supply chain remains inflationary, and technician labor rates have just kept increasing.
But maintenance only accounts for half of that 8-cent margin hit.
True.
The other half stems from insurance and claims, which brings us to a really fascinating legal risk detailed in the report. They explicitly call out the Supreme Court's recent Montgomery decision as a material risk that is expanding their liability and driving up insurance expenses.
Yeah, the legal landscape for freight liability literally just shifted beneath their feet.
So what exactly is this decision?
So the Montgomery decision addresses a highly specific yet foundational legal defense in the logistics industry regarding federal preemption. Historically, the Federal Aviation Administration Authorization Act, or the FAAA.
Right, the FAA.
Yeah, it shielded freight brokers from state-level personal injury lawsuits. The logic was that federal law preempts state laws related to the price, route, or service of a motor carrier or broker.
So if a broker hired a trucking company and that truck got into a catastrophic accident, plaintiffs generally couldn't sue the broker in state court for negligent hiring because the broker was shielded by that federal preemption.
Exactly. The argument was they only brokered the freight, they didn't actually operate the truck.
That makes sense.
And that was the prevailing shield. However, the Montgomery ruling essentially pierced that federal preemption for certain personal injury claims.
Oh.
Yeah. It determined that state-level negligent hiring claims actually fall under the safety regulatory exception of the FAAA.
Okay, so what does that mean in practice?
Now, if a broker selects a carrier with a questionable safety record and that carrier causes an accident, plaintiffs can completely bypass the federal shield. They can sue the broker directly in state court for negligence.
That drastically expands their liability surface area.
Massively.
And in an era of, nuclear verdicts where juries are handing down judgments in the tens or hundreds of millions of dollars against transportation companies, the timing couldn't really be worse.
No, it's terrible timing.
Covenant notes in their disclosures that they utilize high retention levels for their insurance. Basically, they self-insure for a massive initial layer of liability before their external umbrella policies even kick in.
And when your liability surface area expands due to a Supreme Court ruling and you self-insure a large portion of your risk, your actuaries have to immediately adjust.
They have to price in the new reality.
Exactly. You are forced to hike your internal financial reserves to account for the increased probability of litigation and higher settlement costs. That reserve allocation flows directly through the income statement as an expense.
Suppressing earnings even if an accident hasn't actually happened yet.
Yes, it hits the bottom line immediately.
It is a phenomenal example of how regulatory and legal shifts in Washington directly erode the operating ratio of a logistics company in Tennessee.
It really is all connected.
So let's transition to the other side of Covenant's operations, their asset-light division, which they call managed freight. This segment handles freight brokerage, warehousing, transportation management. They don't own the trucks here. They act as the intermediary matching shippers with third-party carriers.
And on paper, this division showed explosive top-line growth. Managed freight revenue surged 28.4% year-over-year to nearly $99.5 million for the quarter.
That's huge.
It is, though it was largely driven by acquisitions completed in late 2025.
But the operating ratio actually deteriorated.
Yeah.
Despite adding tens of millions in new revenue, they suffered what management termed early cycle margin compression. So if they don't have the maintenance headaches of aging tractors and they're generating this much new revenue, how exactly are they losing margin?
Well, it comes down to the fundamental mechanics of a freight brokerage, which essentially operates by shorting capacity.
Okay, explain that.
So, a broker secures a contract with a shipper to move a load of freight next week for a fixed price, say $2,000. The broker then turns to the spot market to find a truck driver willing to haul it for $1,700.
And the $300 spread is the broker's gross margin.
Exactly.
But Covenant noted that the broader freight market is strengthening and spot rates are rising.
Which triggers the squeeze. Early in a market upcycle, the cost to secure third-party truck capacity in the spot market rises rapidly as the supply of available trucks tightens up.
Yeah, okay.
But the broker's revenue is temporarily capped because they are locked into those fixed pre-negotiated rates with their shipping customers.
So using your example, they contracted with the shipper for $2,000. But by the time they go to the spot market to buy the capacity, the truck costs $2,100.
Yep, they are upside down.
They're taking a loss on the load just to honor the customer contract and keep the freight moving. They are essentially subsidizing their shipper's supply chain costs out of their own operating margins.
That is the textbook definition of early cycle margin compression. Capacity costs increase faster than the broker can push rate increases through to their contracted customers.
And management did note they are actively implementing rate increases, but, there's always a lag in the contracting cycle.
Right, it takes time. The broker just absorbs the financial pain while waiting for the new rates to take effect. Furthermore, you mentioned their late 2025 acquisitions. Integrating new acquisitions usually involves carrying redundant overhead and technology costs for a few quarters.
Which puts even further pressure on the operating ratio during this margin squeeze.
Exactly.
It paints a pretty bleak picture for the quarter. The asset-based trucking side is absorbing hits from deferred maintenance and expanded legal liabilities, while the asset-light brokerage side is trapped upside down between fixed customer contracts and an inflationary spot market.
It's a tough spot.
Yet, despite these structural headwinds, Covenant still posted positive net income.
They did.
They buffered this quarter through a massive contribution from an equity investment in a company called Transport Enterprise Leasing, or TEL.
Right. Covenant holds a 49% equity stake in TL, which is a major player in equipment leasing and used truck sales. This investment acts as a really vital counter-cyclical lever in their corporate structure.
TLL contributed $5.3 million in pre-tax net income this quarter, which translates to roughly 16 cents per share. For context, they only reported 32 cents of diluted EPS in total.
So half.
Literally half of their earnings power this quarter came from this unconsolidated equity investment. The report explicitly attributes TL's overperformance to higher equipment sale gains.
And it reveals a fascinating natural hedge within the freight economy.
How so?
When the freight market strengthens and spot rates rise, independent owner-operators and smaller trucking fleets suddenly have better cash flow. They use that capital to upgrade their equipment.
Oh, I see.
Yeah, so demand for used trucks and trailers surges, driving up asset values and allowing leasing companies like TLL to realize massive gains on the sale of their off-lease equipment.
Okay, but let me push back on this because it looks like Covenant is using a one-off used truck boom to just paper over a terrible operating performance in their core logistics business.
I mean, you're not wrong to look at it that way.
They are making a killing selling used equipment to the exact same owner-operators who are currently squeezing their brokerage margins by charging higher spot rates. Like, how sustainable is it to rely on flipping used trucks to buffer an underperforming logistics operation?
It is not sustainable over the long term, and honestly, management is well aware of that limitation. CFO Tripp Grant specifically addressed this in his forward-looking commentary.
What did he say?
He projected a modest sequential increase in earnings per share for the third quarter based on improvements in the core logistics margins, but he explicitly warned that this operational improvement will be partially offset by a drop-off in TEL equipment sales.
Ah, so the lifeboat is springing a leak right as they hope the main engines restart.
Exactly. The used equipment market is deeply cyclical. Once the initial rush of fleet upgrades is complete, those equipment sale gains will normalize, and Covenant's core logistics operations will just have to stand on their own unit economics.
Which brings us back to their overarching strategy. Every decision we have analyzed today, shrinking the spot market footprint, migrating to dedicated agricultural protein contracts, managing an aging fleet to avoid debt, and absorbing a temporary margin squeeze in the brokerage division, it all points to a management team playing a highly defensive long-term game.
Right. They are actively trading the vanity of top-line volume for the durability of committed contracts.
They are structuring the balance sheet and the revenue mix to survive the next freight recession, even if the transition is messy and expensive today.
It's all about predictability for them.
But before we wrap up this analysis, there is a glaring contradiction buried in the risk factors of this 10Q report that warrants serious scrutiny. We just spent this deep dive analyzing how Covenant is fleeing the financial volatility of the uncommitted spot market by concentrating their dedicated business into the agricultural protein supply chain.
Right.
They view hauling meat and poultry as a safe harbor of stable multi-year contracts.
Because it provides pricing predictability and asset utilization that the dry van spot market simply cannot offer.
But look at the specific threats they outline in their forward-looking risk disclosures. They explicitly cite the impact of climate change and the severe threat of a large-scale avian flu outbreak among the nation's poultry flock. Are they actually mitigating their exposure, or are they simply trading predictable financial market risks for the completely unpredictable risks of nature?
It is a critical vulnerability. The agricultural supply chain is highly, highly susceptible to biological shocks.
I mean, think about it. If a massive avian flu outbreak forces the culling of millions of birds and temporarily halts regional poultry processing, all of those beautiful, high-yield, multi-year committed contracts suddenly have absolutely zero freight to haul.
The trucks just sit empty, but the overhead remains.
Exactly. They have built a fortress against economic volatility, but that fortress is built squarely on the health of the American food supply chain.
Which demonstrates that in the logistics sector, true risk mitigation is kind of an illusion. You cannot eliminate risk. You merely select which specific category of risk your balance sheet is best capitalized to absorb.
Yeah.
They have chosen biological and specialized supply chain risk over pure economic cycle risk.
It's a calculated gamble, and it's one that we will be watching closely as the freight cycle matures. That covers the mechanics behind Covenant Logistics' second quarter. For daily earnings coverage, structural market analysis, and a breakdown of the unit economics driving the market, make sure you follow the show. We will see you on the next deep dive.